This is part 1 of the presentation for Module 1 of Accounting 311, Financial Statement Analysis for Global Entrepreneurs. In this module, we will introduce a 4-step framework for analysis and valuation. The first step is to understand the business environment and accounting information. The second step is to adjust and assess financial information. The third is to forecast future payoffs such as earnings, cash flows, or dividends. And the fourth and last step will be to use forecasted information to estimate firm value. In this module, we will learn what financial statement analysis is and how it relates to business valuation. As the slide indicates, financial statement analysis is a process of extracting information from financial statements to better understand a company's current and future performance and financial condition. There are many users of financial statement information. Management uses financial statements to raise financing for the company, to meet disclosure requirements, and to serve as benchmarks for executive bonuses. Investors and analysts use financial statements to help decide whether to buy or sell stock. Creditors and rating agencies use financial statements to help decide on the credit worthiness of a company's debt and lending terms. Regulatory agencies use financial statements to encourage enactment of social and economic policies and to monitor compliance with laws. These decision makers rely on financial statements for purposes ranging from determining demands in labor union negotiations to assessing damages for environmental abuses. The end process of financial statement analysis can be to estimate a company's worth. A company's worth can be viewed as a collection of assets, and those assets have claims on them. There are different types of claims. Owner's claims are reflected in equity shares of a company. Non-owner claims are reflected in obligations and debt shares of the company. The valuation process seeks to assess the worth of equity shares or debt shares or both. The first step in financial statement analysis is to understand the business environment and accounting. As we mentioned previously, there are many users of financial statement information, but the three main user groups are the investors and equity analysts, lenders and creditor analysts, and company managers and employees. Each group uses the financial statements for their specific purposes. To analyze and use the accounting information, we must understand the three main business activities of every firm. First, companies must plan what activities they will engage in, and then determine how to best obtain the finances to invest in those activities. Once the company has begun to operate, they will hire and train employees, manufacture products, deliver services, market and sell their products and services, and manage after-sale customer support. This diagram shows that business activities occur within a particular business environment characterized by a number of business forces, including market conditions, competitive pressures, and regulations. These forces affect the way the company does business and shapes the company's overarching goals and objectives, along with the company's strategy and its strategic planning process. A company's strategic plan reflects how it plans to achieve its goals and objectives. A plan's success depends on an effective analysis of market demand and supply. Specifically, a company must assess demand for its product and services and assess the supply of its inputs. Past financial statement information plays an important part in the business planning process. First, the financial statements can be used to assess the success of past strategic plans. Management uses the information to take corrective action and make new operating, investing, and financing decisions. These new actions yield the current financial information on the right side of the exhibit, and the process starts anew. Understanding a company's strategic plan helps focus our analysis of financial statements by placing them in proper context. Demand for financial statements has existed for centuries as a means to facilitate efficient contracting and risk sharing. Decision makers and other stakeholders demand information on a company's past and prospective returns and risk. Supply of financial statements is driven by companies' wish to lower financing costs and other costs such as political, contracting, and labor. Managers and employees are interested in the company's current and future financial health. This leads to a demand for accounting information on the financial condition, profitability, and perspectives of their companies, as well as comparative financial information on competing companies and business opportunities. Investment analysts and other information intermediaries, such as financial press writers and business commentators, are interested in predicting companies' future performance. Expectations about future profitability and the ability to generate cash impact stock price and a company's ability to borrow money at favorable terms. Financial reports reflect information about past performance and current resources available to companies. Banks and other lenders demand financial and accounting information to help determine loan terms, loan amounts, interest rates, and required collateral. Loan agreements often include contractual requirements called covenants that restrict the borrower's behavior in some fashion. Stockholders and directors and others, such as investment analysts, brokers, and potential investors, demand financial accounting information to assess the profitability and risk of companies and other information useful in their investment decisions. Financial analysts use financial information to estimate company value and to form buy-sell stock strategies. Customers, both current and potential, demand accounting information to assess a company's ability to provide products or services and to assess the company's staying power and reliability. Strategic partners wish to estimate the company's profitability to assess the fairness of returns on mutual transactions and strategic alliances. Regulators such as the SEC, the Federal Trade Commission, and the Federal Reserve Bank, and tax agencies demand accounting information for antitrust assessments, public protection, setting prices, import-export analysis, and setting tax policies. Voters and their representatives to national, state, and local governments demand accounting information for policy decisions. The decisions can involve economic, social, taxation, and other initiatives. Voters and their representatives also use accounting information to monitor government spending. In general, the quantity and quality of accounting information that companies supply are determined by managers' assessments of the benefits and cost of disclosure. Managers release information provided the benefits of disclosing that information outweigh the cost of doing so. Both regulation and bargaining power affect disclosure cost and benefits and thus play roles in determining the supply of accounting information. Most areas of the world regulate the minimum levels of accounting disclosures. In the United States, publicly traded firms must file financial accounting information with the SEC. The two main compulsory SEC filings include the first, which is a Form 10-K that contains the audited annual reports, including the 4 financial statements with explanatory notes and management's discussion and analysis of financial results. The second is Form 10-Q, which contains unaudited quarterly reports that include summary versions of the 4 financial statements and limited additional disclosures. The benefits of supplying accounting information extend to a company's capital, labor, input, and output markets. Companies must compete in these markets. For example, capital markets provide debt and equity financing. The better a company's prospects, the lower its cost of capital, as reflected in lower interest rates or higher stock prices. The same holds for a company's recruiting efforts in labor markets and its ability to establish superior supplier-customer relations in the input and output markets. What inhibits companies from producing false or misleading good news? Well, there are several constraints. An important constraint is imposed by stockholders in that of audit requirements and legal repercussions associated with inaccurate accounting information. Another relates to reputation effects from disclosure, as subsequent events either support or refute earlier news. The costs of supplying financial information include the preparation and dissemination costs. Even though companies might already have gathered the information for internal use, the cost of auditing the information and complying with the SEC rules can be time-consuming and costly. Disclosing product or segment successes, strategic alliances or pursuits, technological or system innovations, and product or process quality improvements could reduce or eliminate a company's competitive advantage. Risk of litigation increases if companies disclose information that creates expectations that are not met. The cost of defending against customer or investor lawsuits is not inconsequential, even for cases that are dismissed. Highly visible companies can face political and public pressure. For example, government defense contractors, large software conglomerates, and oil companies are favorite targets of public scrutiny. Extra disclosure can increase this scrutiny. The SEC adopted Regulation Fair Disclosure, or FD, or Regulation FD for short, to curb the practice of selective disclosure by public companies, called issuers by the SEC, to certain stockholders and financial analysts. In the past, many companies disclosed important information in meetings and conference calls that excluded individual stockholders. The goal of this rule is to level the playing field for all investors. Companies in more than 120 countries, including the European Union, the United Kingdom, Canada, and Japan, use International Financial Reporting Standards, or IFRS, for their own financial reports. Headquartered in London, the International Standards Board, or IASB, oversees the development of IFRS, while the IASB and the Financial Accounting Standards Board, or FASB, operate as independent standard-setting bodies. The two boards work together cooperatively, often undertaking joint projects. Consequently, IFRS and U.S. GAAP, or Generally Accepted Accounting Principles, are generally more alike than different for most transactions. Companies use 4 financial statements to periodically report on business activities. These statements are the balance sheet, income statement, statement of stockholders' equity, and statement of cash flows. This slide shows how the 4 statements are linked across time. A balance sheet reports on a company's financial position at a point in time. The income statement, statement of stockholders' equity, and the statement of cash flows report on performance over a period of time. The 3 statements in the middle link the balance sheet from the beginning to the end of the period. The balance sheet reports the company's resources or assets, namely what the company owns at a point in time. The balance sheet also reports the sources of asset financing. There are 2 ways a company can finance its assets. It can raise money from stockholders, called owner financing. It can also raise money from banks or other creditors and suppliers, called non-owner financing. This means that both owners and non-owners hold claims on a company's assets. Owners' claims on assets are referred to as equity, and non-owner claims are referred to as liabilities or debt. Since all financing must be invested in something, we obtain the following basic relationship. Investing equals financing. The equality of the relationship is called the accounting equation, which is assets are equal to liabilities plus equity, or as shown on the slide, investing is equal to non-owner plus owner financing. This slide shows the balance sheet for Apple as of September 29, 2018. The title shows that this is a consolidated balance sheet, meaning that it is for Apple and the subsidiaries for which it holds a controlling interest. The assets are classified into short-term and long-term. The assets are listed according to their liquidity, which means their nearness to cash, with short-term assets, called current assets, listed first because they are expected to generate cash within 1 year of the balance sheet date. The first short-term asset is usually cash, then accounts receivable, and then inventories. Land, building, and equipment, often called property, plant, and equipment, will generate cash over the long term and are therefore classified as long-term assets. We can see how the balance sheet gets its name because the assets equal the sum of the liabilities plus the equity. The relative proportion of short-term and long-term assets is largely determined by a company's industry and business model. This is evident in the graph on this slide. Larger investments in short-term assets occur at companies such as Best Buy, Starbucks, and Nordstrom's that carry relatively high levels of inventory. High current assets also occur for technology companies like Alphabet, the parent of Google, and Cisco that have high cash balances and large investments in marketable securities. Manufacturers, on the other hand, like 3M, Johnson & Johnson, and Colgate-Palmolive, require more investment in property, plant, and equipment, and at the very extreme end are capital-intensive transportation and communication industries with members such as Southwest and Comcast, who carry large percentages of long-term assets on their balance sheets. Assets are financed by a combination of non-owner financing, or liabilities, and owner financing, or equity. As we can see by the chart, there are wide variations in the percentages of non-owner and owner financing among major corporations in the United States, ranging from almost all non-owner financing in the case of Colgate-Palmolive, Starbucks, and Nordstrom, to a large proportion of owner financing in companies such as Procter & Gamble, Intel, and Alphabet. Most public companies tend to use slightly more debt than equity in their capital structures due to the benefits of leverage, which we will discuss in more detail in a later module. An income statement reports on a company's performance over a period of time and lists amounts for its top line revenues, also called sales, and its expenses. Revenues less expenses equals the bottom line, net income, also called profit or earnings. Apple is typical of companies that sell products. It reports two basic kinds of operating expenses: cost of goods sold and selling, general, and administrative expenses. Apple's income statement shows its revenues, cost of goods sold, and operating expenses. After interest income and income taxes, the company reports net income. Net income reflects the profit or earnings to the company's shareholders for the period. While revenues represent the retail selling price of the goods sold to customers, cost of goods sold is the amount Apple paid to purchase or manufacture the goods or inventories that it sold. Manufacturing and merchandising companies typically include a subtotal called gross profit, which is revenues less cost of goods sold. Apple's overhead is reported in the selling, general, and administrative expenses that include salaries, marketing costs, occupancy costs, HR and IT costs, and all of the other operating expenses the company incurs other than the cost of purchasing or manufacturing, which is included in cost of goods sold. Relative profitability or net income as a percent of sales differs widely across industries and even among companies in the same industry. Although effective managers can increase their company's profitability, business models play a large part in determining profit levels. The differences are illustrated in the graph on this slide, with Intel having a large percentage of operating profit as a percentage of sales, but Best Buy operates with a very narrow profit margin. A company's ability to create barriers to competitive pressure, either by patent protection, effective marketing, or otherwise, is a key factor in determining their level of profitability. Those that compete in a highly competitive market with little product differentiation must concentrate on controlling operating expenses to offset lower gross profits. The statement of stockholders' equity reports on year-over-year changes in the equity accounts that are reported on the balance sheet. Contributed capital represents assets the company received from issuing stock to stockholders or shareholders. The retained earnings, also called earned capital or reinvested capital, represents the cumulative total amount of income the company has earned and that has been retained in the business, that is, not distributed to stockholders in the form of dividends. There are other components of equity, such as treasury stock and accumulated other comprehensive income, that will be discussed in other modules in the text. This slide shows the statement of stockholders' equity for Apple. During the recent period, Apple's equity changed because it issued shares, earned net income, issued dividends, repurchased some of its own shares, and had other equity changes. The statement of cash flows reports the change, either an increase or decrease, in a company's cash balance over time. The statement reports cash inflows and outflows from operating, investing, and financing activities over a period of time. Apple's cash balance increased in fiscal 2018 owing to its operating activities increasing cash flows, net investing cash inflows, and net financing outflows. Important financial information about a company is communicated to various decision makers through means other than the four financial statements. These additional information sources include the management discussion and analysis section of the annual report, the independent auditor report, financial statement footnotes, and regulatory filings, including proxy statements and other SEC filings. This is the end of part 1 of the presentation for Module 1.